So, we will be discussing chapter 4 under your study pack. It is about valuation of bonds. If you have looked at valuation chapter, what we have done at the beginning, I think there is another webinar we have done for valuation of shares actually, and the debt also I have touched on it. So, the concept remains to be the same, but definitely we need to learn certain things about the bonds, right? Broadly the wording, the concepts and what are relevant to our understanding on this topic we will discuss. But if you are just looking at the valuation per se, it is the same knowledge what you have gathered on the valuation of debt earlier chapter. Okay. So, page number 68 or 67, right. So, you will see there are the characteristics are explained. For me, like the bond is we need to look at the characteristics as characteristics are: one, it is about a long term debt instrument. Actually, it is a long term debt instrument. It is not short term. It is generally more than 1 year. That is why we call it a long term. And it is a debt instrument. It is not equity instrument. There may be there is another webinar on the equity financing I have done, that you would have seen it. There, if you see, it is about the share issue. The company is raising money by issuing shares. So, we need to know the difference between a share and a debt instrument. Shares are giving the ownership of a company, a percentage or some number of shares we own, there you get a small percentage. That ownership will entitle you to be the part of the company, and you are entitled to dividends, and you are entitled to the value appreciation of the company, and you are entitled to attend AGM or the extraordinary general meeting of the company, that is shareholders meeting. And if you have, depends on your ownership percentage, you have certain chances of becoming board of director. All that is the share issue giving entitlements. So, we discussed that under equity finance. I am not repeating that again, but just to compare that equity financing, when it comes to the debt side, debt is actually a borrowing. You are talking about borrowing. You borrow money for your business operations. So, any company who needs to raise money from a debt instrument can issue a debt instrument and borrow money from it can be public at large or certain institutions or certain people. So, it is about again a long term debt instrument. If you take in Sri Lankan context, we have government securities, which are government. Sri Lankan government issue the bond and borrow money. So, it can be from the public at large or it can be from the institution. Generally, it is institutions where banks, insurance companies, provident funds or pension funds and other unit trust companies and even other corporates, in addition to that the public at large. So, those are the people who generally invest in bonds, of the government bonds I am talking. So, government also issue bonds and raise money. So, why the government issue bonds to raise money? Various purposes, but mainly it is for their expenses or maybe to the capital expenditure. For the government funding requirement, government can issue bonds and borrow money. So, through say central bank, government could do the transaction. So, the people or the investor could invest in the bonds. So, when you take the bond, you can look at it from the concept of who are the people issuing. It can be government or it could be private. So, private sector or government. Government, when they issue, we call that is the treasury bond, because it is the government is issuing treasury bond. Similarly, the corporates are the private sector companies, larger companies also can issue treasury bonds, or not treasury bonds, bonds, they generally use the word debentures, right. You can use bond also for the corporate bond here, you can call it corporate bond, but actually it is debentures in Sri Lankan context we are issuing. So, for your understanding purpose, you can think that there are two ways that bonds can be issued. One is the government is issuing, other one is the private sector. Government issuing is treasury bonds, and private sector generally we can call that as a corporate bond or debentures. Both are issuing for debt as a debt instrument, that means they are borrowing money, and for long term. It is not short term, they want the money for long term, that means they will be returning the money to the investor only after 1 year, or it is a very longer period. It is not shorter period, it is a longer period. So, that is a basic thing you need to get into your mind. It can be a long term, it could be a debt instrument and with a long term nature. In the issue of this, the government, when I say, generally we all know that treasury bond is common, but even under government you would have seen there are bonds issued by UDA in Sri Lanka. Urban Development Authority, you can see that they have issued bonds, because when they wanted to develop the certain area or to do a project of housing project, the UDA was issuing a bond, long term bond, and raise money for that purpose. And other parts of the world, there are municipal bonds, like municipal council. In Sri Lanka we have municipal CMC. So, CMC wants money, for example. They want money to fund their normal day to day activities or some capital expenditure. They want money. So, what they do? They can issue a bond, right? They can issue a bond and raise money. Sri Lankan context, we have not had still municipal bonds, but we have definitely treasury bonds and UDA bonds. Apart from that, the bonds issued by treasury bonds and UDA, the government issue international sovereign bonds, right. So, they also issue in terms of foreign currency, it is not in Sri Lankan rupee you invest. So, you can invest in foreign currency into international sovereign bonds. So, that is not only for you, it is mainly targeting the foreign international, so that you want money for Sri Lanka. So, you issue international sovereign bonds and raise money to Sri Lanka. So, you would have seen the papers, a lot of issues happens and then they get money for the government. When there is a dollar need, government can go for that a dollar bond and raise money. So, again the nature is the same, long term debt instrument, only the difference is the currency and maybe the target market could be different, that is not Sri Lankan only, you are talking about international people, that is foreign companies or foreign investors. So, please be aware that the bond, when I say the broadly the name, it could be government or private sector, sector wise. Government, you can have treasury bond, which is very common, very much traded, very active traded bonds. In Sri Lanka, treasury bonds are traded regularly. And then you have UDA bond, which is of course very one or two transactions like that. And then we have private sector. Municipal bond we don't have much, so we don't have actually, so we don't want to talk about it. And we can, if you want, you can talk about the ISB, international sovereign bonds. As I mentioned, it is in dollars or foreign currency. So, you have foreign currency bonds also. So, this is what government is issuing, nature is long term debt instrument. Coming to private sector are the one who is issuing debentures or corporate bond we call it, again for a long term nature, not 1 year, more than 1 year. Generally it is 5 years or it could be 7 years. So, 3 to 7 years period you can see bonds, but 5 years is common, and the debt instrument, it is a long term. So, they are also borrowing, corporates are also borrowing to fund their capital needs. I think we would have discussed somewhere else, right, the company's long term assets, if you are going for a capital expenditure, you are going for a project or you are going to put up a building, what do? In order to fund your project, you will borrow money. You can take shareholders or equity finance or you can borrow money. So, the borrowing you can do it from the bank or you can issue debentures or bonds. So, you corporate, you are a company, could go and issue debentures to the public at large or the institutional people and raise money for funding your capital expenditure. So, this is a common thing company could do. Now, we will discuss exactly why the company could do depends on the organization need. It can be for the capital expenditure only, or it can be your sustainability purpose. That means you want to run your operation properly, where you need long term funding and you are able to borrow money in terms of debenture. What are things to be considered when you are issuing debenture? I think that's actually some of the other area what you have learned in the past could help you to understand. One is that how much money you are requiring and what is the capital structure or the gearing. If your gearing is very much lower, you always prefer to go for debt borrowing. That means it can be bank loan or it can be debenture. If you are talking about the other aspects, one is your capital need and the amount of money and the capital structure. Then how much you are going to make out of that investment, the return what you are going to get from that investment. Ideally, the return needs to be more than your cost of debt. If you are going to borrow from the debenture say 8%, and your return of the debenture or the return of that investment should be more than 8%. Otherwise, it's not worth it to borrow money and invest. That we have discussed in the capital structure chapter, right? So please be aware that you have to look at capital structure, you have to look at the return what you are getting from the investment, and your cash flows, your ability to repay your interest and the capital on a timely basis. Repayment of interest and capital also has to be considered based on your cash flow available. So you have to forecast your future cash flows and see whether I am able to make these repayments of terms of interest and capital. So that has to be looked after. So basically you have to look at various things when you are going for debentures, and whether it's a floating rate, fixed interest rate. So those are the considerations when you make. I think maybe we will discuss little later, right? You will have various types of debentures in order to accommodate your requirement. So coming back to the corporate bonds, so this is the like a broader outline. I would say that bonds can be issued by corporates or government. So keeping that knowledge, then moving on, the characteristics of bonds. So you have a long term debt instrument. Then it is generally the interest, what you call is interest on the instrument, is paid as coupon rate. We can coupons. Interest is paid in terms of coupons. So most of the bonds, I think there will be like a zero coupon bond where there is no coupon. But otherwise all the bonds will have a coupon. Coupon rate mean you say your bond is rupees 1,000 rupees, it's a nominal value, and your coupon rate say 10%, coupon rate 10% per annum. So what you do, you have to calculate your coupon rates annually. Assume that it's annually you are paying. So it's about 100 rupees. And if you say 5-year debenture or 5-year bond, you are talking about you are going to get as an investor 100 rupee interest every year for 5-year period. So this is your coupon rate, coupon interest. So the interest is generally given in terms of coupons. We call it coupon, that is because you are going to calculate your interest on a nominal value. You are going to calculate your interest on nominal value. So nominal value in this case is 1,000 rupees, right? So you have to understand it could be 100 or 1,000 like a identifiable value. On that you pay a coupon rate, or the company will pay a coupon rate. So investor gets that as the interest. He gets as the interest. So this is common. It's common. The coupon can be sometimes paid half yearly. That means 2 times a year. So if you take 5-year debenture or a bond, 10 times a year you will get interest. So as an investor, I get 10 times the interest. But it's calculated again on the nominal value. So the rate can vary. They will say, okay, 5% for 6 months. Like that, you can have a rate, right? So you will be paid based on the nominal value. So interest is one thing which is to be known to you. It's a coupon rate. Based on the nominal value, they will calculate and pay the investor, or investor is paid. Then you have something called maturity value. Maturity value is actually the redemption value. If you take the debenture, when the debenture is issued or the bond is issued by anybody, there is a redemption value. Most of the time redemption value is same as nominal value. So if you say 1,000 rupees, your redemption value is 1,000 rupees. but it can vary. It can be with a premium. Some debentures they can say, okay, we will be redeeming with a premium of 5%. So in addition to the coupon rate what you get paid, there is additional capital gain, because your 1000 rupees, sometimes they will say 5% more than 1000 I will pay at the end of 5 years. So 5% is 50 rupees. So you get 1050 at the maturity in addition to your annual coupon interest. So please be aware that the maturity value is the redemption value. Redemption value is also having a characteristic, because you need to know that is something you have to look for when you are going to do some calculations. Then you will see the bonds have the nature of secured and unsecured. Secured and unsecured. What do you mean that? Any bond when you are issuing, you may call it as an unsecured bond or secured bond. Security means when the investor is investing in that bond, he is not only given an instrument saying debenture or bond, he is given some sort of a security from the assets of the company which are assigned or mortgaged to that instrument. So that basically anybody who invests in the debenture, when the company goes into difficulties and can't pay the debenture, that debenture holders have the right to claim that money from the assets which were mortgaged to the debenture. So company issuing debentures of, it's like you getting a bank loan and providing your asset as a security. You just say you are going for a housing loan, you go and buy a house or build a house and you take the borrowing from the bank will say, okay, can you mortgage your house to us? So you mortgage the asset to the bank and borrow money. So it's a common thing. So what we have to understand, the debentures also can be issued with the security. You might say your building is secured against the debenture. So it's not about one bank, one person. Here we have to have debenture holders mean many people. Government, it won't apply, because government generally goes on an unsecured basis. Because government in Sri Lanka or anywhere, the general assumption is government does not default. So that's a we have to take it as an assumption. It is inbuilt, and by default they won't default, right? So you don't understand, you don't want to worry about when you invest in government bonds. You believe that they will somehow make sure that you get your money. The reason being, government have the ability of printing money. So as you all know that government has the ability, only government has the ability and the right to print money. So even if you say that government doesn't have money to pay you a bond at one time, government can print money and give it to you. So the default risk in the government bond is not there, right? So very exceptionally you might say, okay, that maybe say Sri Lankan Electricity Board is issuing a bond and the government is maybe supporting, but later it may not be paying. So there could be some sort of a doubt you may have for certain times, but as an overall conceptually you need to understand government bonds are not defaulted. Government will not default. So the assumption is government bonds, don't worry about it, is risk free. That's why we call it government bonds as risk free instrument. Risk free instrument. What the risk here we are meaning, actually default risk. Risk free instrument. Risk free instrument means there is no risk in the instrument. As an investor, when you make the investment in the risk free instrument, which is government securities, which are debentures or the government bond or treasury bill, where you invest, treasury bills are within 1 year period, when you invest there, the advantage you have is you don't have to worry about your money, capital money being lost, even the interest. You don't have to worry about it. But even the corporate sector, we believe that the corporate sector are good, there are performing companies are there, all that fine, but there is always a percentage of risk you have to accept. Sometimes the company can go bust, that means they can become bankrupt. So it may be not for sure, but can happen. Government, don't worry about it, government will somehow make the payment. So therefore the government bonds or treasury bills, we call it risk-free instruments, so there is no risk of default. So you don't have to worry about it. So therefore security aspect, when the government is issuing or government institutions are issuing bonds, it's not required to give a additional security for support to your bond. So government, when they give the instrument, that's it. You don't have to get another security for that. So private sector bonds, for private sector corporate bonds or debentures, you have two categories generally, secured and unsecured. Secured and unsecured. Security means they have to provide you a building or machinery or some asset and say these assets are a kind of mortgage to the instrument. So any time if the company defaults, that the instrument holders, that is debenture holders, the debenture holder has the right to claim the money from the company specific asset. Specific asset, it's since like mortgaged to that instrument, you can be able to get the money. So secured and unsecured is a characteristic you will have in debentures, corporate, especially in the private sector. Only thing, if you really look at in Sri Lanka, the debentures issued by corporates are mostly banks, all the leading banks you would have seen, they have issued under Basel requirement, they have issued bonds and raised money. So it's part of their capital raising exercise, right, for their regulatory purposes or their funding purposes, expansion purposes, they would have borrowed money in debenture form. Only thing is those debentures are generally unsecured. Very rarely you would go for a secured debenture because most of these banks are well known and they have got a name, right? So the defaulting chances are very less, right? If you are going to think that banks is going to default, that means we are in a very uncertain environment in Sri Lanka. So I don't think that any bank, for that matter, we should doubt that bank will default. I don't think any bank would be defaulting because regulations are so strong and the banks are also strong. So all the institutions which are at the moment regulated by the central banks I'm talking, are really good, right? So even if there is one or two banks which have lesser capital or certain concerns, central bank get involved and then make sure that they are fine with the capital requirement. So please be aware that banking system is perfectly there, so we don't have to worry about it. So the security aspect of banks, when they go for debenture, you asking for a security for that, it's not really relevant or required because they are strong bank, right? But if you are talking about any other corporate listed company, but they can go for a debenture issue also, any other corporate, then that corporate you need to look at it and see, you have to assess as an investor when you are going to invest in the corporate company where they are going to issue a debenture without security, then you need to really look at and see whether it is what I could say, whether it's financially strong. You have to evaluate. As an investor, you have to evaluate and then invest, right? So that is something you have to be careful in the sense like there can be companies which are going for debenture issue. You have to really study that company and decide. It's not that something is wrong. You have to look at it and see what banks, I can say, okay, at least basically system point of view, banking system does well and then it's well regulated. So the disadvantage or the chances of it having a failure in terms of defaulting any debenture is very remote, right? Still you would say there is a percentage of risk in any investment, so you keep that, but doubt you shouldn't worry. That means if you were to doubt, then you will doubt your deposits also in the banking sector. So that is something your foundation you are going to break. Secured and unsecured characteristics, then you will see that generally the corporate debts, interest rate type, I would say type, you can have a fixed interest, other one is floating interest. Fixed interest rate or floating interest rate. So you can see corporate bonds generally, I'm not, government bonds also some other characteristics you can relate, some characteristics may not be 100% relevant. So corporate bonds you have these two types, fixed interest rate and floating interest rate, floating and fixed interest rate. So that means when you say 10% is your interest, every year you get 10%. If you are going to get every year 10%, that is fixed interest rate contract or the corporate debt. If you say floating interest rate, your treasury bill or treasury bond rate will be determined based on the market interest rate. So basically what happens is there will be a benchmark rate. We say for example treasury bond rate, if you are saying your corporate bond, you can mention in your corporate bond as a part of a clause or a condition, your interest will be calculated by comparing your corporate bond, similar government bond rate, say for example 1 year or 5 year government bond at this moment is 10%, you pay 10% plus 1%, that is 11% you pay for your corporate bond. So that is what you call floating rate. So every year you will say, okay, we will look at the corporate bond rate and pay you. If you say 5-year bond, every year you look at your 1 year or 5-year corporate or government bond rate and add that 1%. So your clause is that whatever the government bond rate, 5-year bond rate plus 1% is the corporate bond rate. So that's a floating interest rate based on the market rate. Every year it changes. Every year it changes. Fixed interest rate is something for 5 years, same 10% means 10%. So there is what you have to understand. There are two types of rates. One is fixed, other one is variable or temporary, what you call variable or floating interest rate. So that also another characteristic you could say in debenture advertisement. If you say any company going for debenture, you will see that. And the rated, unrated. So this is actually a process. Rating company, you might have heard about Fitch, Standard & Poor, Moody, and whatever the rating company, it could be mostly the foreign rated companies, right? Those rating companies does the evaluation of your company, right, based on your financials, your capability of repaying your capital and interest, and your profitability, various ratios they calculate, and they finally come to a point where and say that your company rated A, AAA rated, or AA rated, or BBB minus. So they can rate your company. So there is a standard thing you would have seen sometimes in the paper advertisement. The company say that we are AAA rated, we are a AAA rated company, or AA rated company. And no one will advertise and say BBB rated company, but generally the A rated companies are trying to put that into the market very much clear, right? So you have a rating. So that rating is a bigger process. These are all well established rating companies in the world, and they have even Sri Lanka representative companies. So they do the rating for your organization and say what is the rating you have. This is actually a kind of a financial evaluation. I think you and me who are finance people who do this kind of work, and then they will say, okay, this company rating is this. They have very clear cut ratios calculation, and they will work out, and then it's like a formula based thing, and then they will tell you this is your rating. Based, if you have ratios like this, you fall into this category. So AAA level to AA, and whether you are stable, non-stable, all these things are rated process. So rating or unrated. So every debenture which is going for issue, generally they have to rate. So that there are two things. One is a company rating, other one is an instrument rating. Company rating means, say for example, bank. Say Sampath Bank is going for debenture issue. Sampath Bank get a rating for the Sampath Bank. That's total picture of the bank, and say whether you are strong or not strong. On the other hand, you might see that Sampath Bank debenture is issued. So the debenture you specifically rate and see whether your debenture, the money what you are going to raise from the debenture, will that be used in a proper manner, and how that debenture will be repaid, interest and capital will be repaid, and whether you have enough cash flows to meet those commitments, and then you rate the debenture specifically, and then debenture is AAA rated, for example. So you can see a company rating or the instrument rating. Apart from that, we have a country rating, that is Sri Lanka as a country we can be rated, and we are rated. So they will say, okay, Sri Lanka rated is this, stable outlook, negative outlook, so that they will rate and say. So apart from the government, we just leave the governments at the moment, rated as a corporate bonds have the rated and unrated characteristic. So what is the advantage? Generally the rated instruments have a better demand in the market than unrated instrument. Why? Rated means that somebody has gone through that company position and independently, and then he tells that this company have a very good financial situation, it won't default the kind of repayments. So this is just some sort of extra support, like auditor giving a certificate. Here somebody is saying that this company rating is this, so independently. So that looks good for everybody. So the rating is something will support the debenture issue, corporate bond issue for the corporates. And further I will say, since we are in a regulated institution, insurance companies and banks and finance companies, when they say they are going for investing in this instrument, there are minimum requirement of rating. So you cannot invest in any corporate bonds. So you need to make sure that your investment in the corporate bond should have a minimum rating of this. So BBB minus. So you should have that minimum rating requirement. So they will have to, the companies have to make sure that your investments are made in the instrument which are having a minimum guideline or minimum requirement. So therefore rating is a benefit for you to sell your products or debentures. Unrated has its disadvantage, as I mentioned. So then when you look at the other stuff, other characteristics, if you look at it, you have a term, period, right? As I mentioned, you have a period or a term. It can be a 1 year debenture, 2 year debenture, 5 year debenture, or it can be any time period. So it depends on the organization requirement of money. The time period can change. Even government has 2 year bond, 3 year bond, 5 year, 10 year, right? It can be very long term also. So in Sri Lanka, mostly within 10 year bonds are mostly traded ones, right? You will see the term of the bonds. That's how long you are going to issue the debenture or the bond to raise money. Then please understand there is another thing, it's called unlisted or listed. Especially this is for private sector corporate bond. The corporate bond can be listed or unlisted, listed or unlisted. So you might see that it has both things. Listed debentures you can trade in the market like shares, you can buy and sell. Debentures also you can buy and sell. Unlisted mean it's only once you invest, you wait till the maturity. You can't trade it. So if you want to raise your money or you want to liquidate your investment, say 5 year debenture you have invested, 2 years down the road you say I want to liquidate and I want to raise money. I want to raise mean I want to realize my investment. You cannot do with the unlisted one. Listed one, yeah, you can trade it in the market and raise your money. So basically realize your money. So this is another characteristics, listed and unlisted. Then in terms of debentures or corporate bonds, you will have the call option or conversion option. So there are two other things, call option and conversion options. What I mean is, after debenture is issued for 5 years, if your debenture, the corporate bond have a characteristic, if the corporate bond has a characteristic of, say, for example, the company can recall the bond. That means company has issued for 5 years. 3 years time, they have option in the agreement or the bond document that says that after 3 years, in case the company wants, they can raise the money back, or not raise the money back, they can return the money to the investor and take the bond back. So that is called call option. You have a chance of calling it back. So it is generally the choice of the institution who issue the bond, so that can be done. Then a conversion option where you will see that these are all corporate bond characteristics I am talking, not the government bonds. Corporate bonds conversion mean you issue the bond 5 years. Maybe at the 5 year end, the investor has a chance to convert your debenture to shares. Conversion. You are converting your debentures to shares. So that means you have opportunity of becoming shareholder of the company at a point in time, even though you at the beginning you are a debenture holder or you are invested in a debt instrument. So these are also some of the things you need to be knowledgeable, options available in the corporate bonds. In terms of the government bonds, right, or even the corporate bond, the return we used to call the name called yield, right? Corporate bond, or it's mainly the government bonds, we generally use the word yield. Yield is the instrument. Yield is the return of the instrument. So actually the yield, when we say, it's actually the IRR. Yield of the instrument is the IRR of your debenture or the government bond. So when you calculate the IRR of the debenture or government bond, that gives you the yield of the instrument. So this is a return of the instrument. So when we talked about coupon rate, that is on the nominal value what you will be paid, cash flow. Cash flow point of view, from your nominal value, how much you are going to pay is your coupon rate. So if I say 10% is your coupon rate, you get out of 1000, 10% you get mean 100 rupees you get annually. That is your coupon interest. But yield is your return. Yield is the return. So that can be different to your coupon rate. Depends on your market value of your debenture, your yield will vary. Your yield will vary. We will look at the calculation later. So you will see there are a lot of things we discussed. These are all relevant to the understanding of the word called bond. What are characteristics when you read an advertisement of a company, their debenture? You look for these things. What are these? How much the maturity value? What is your interest coupon? And what is your what is the tenor? Tenor means the period. Whether it's secured, unsecured, whether rated or unrated. And then you have a listed or unlisted nature, so that I can raise money or realize my money later. Call option is there or not? Conversion option is there or not? So you will see there are a lot of characteristics a bond can have. Mostly the characteristics are private sector corporate bond, but it can be some other things are definitely applicable to government bonds also. Then moving on the study pack. So I initially gave you the understanding so that it's easier when you read it out. So whatever I discussed, you can see that. Maybe the word zero coupon bond. Now as I mentioned, normally bond, say 1000 rupees is your nominal value. Say 5 years is your maturity or redemption period 5 years. Say your interest rate or the coupon rate 10%. And your maturity value is 1000. So you get 1000 rupee nominal value bond, maturity is 5 years, 10% coupon rate, every year you get coupon rate 10%, and maturity value 1000. So as an investor, when I invest 1000 rupee in this bond or debenture, I get annually year 1 to year 5, I get 100 rupees by 10% into nominal value. This can be nominal value, you can call it nominal value or face value. So nominal value of face value is 1000, on which I have to pay interest. So the company I have to pay or government has to pay 10% interest. I get year 1 to 5, 100 rupees. That's my investment income, interest income. Year 5, the investor or the company will pay the 1000 rupee. That's your nominal value you invested at the beginning. So you get the 1000 rupee back at the year end or year 5 as the maturity value. So as an investor, the process is that you are investing 1000 rupee in year 0 today. Every year you get 100 rupee interest. End of 5 years you get 1000 rupees. So what I am trying to tell you, your total cash flow is going to be 100 rupee for 5 years every year, and end of 5 years you get 1000, and you invest 1000. So actually you are invested, your nominal value say 1000, and this is your total cash flows involved in your debenture or a corporate bond or the government bond. Basic example I am talking. Now what is your return of the bond? Return or yield of the bond, how much? Return or yield of this bond is issued at 1000, redeemed at 1000, and annually you are paying coupon rate of 10%. So your return is going to be 10% per annum. Annually you are going to get 10% per annum is your yield or return of this debenture. So this is a simple example of a debenture. So what are the cash flow involved? You invest 1000 rupee, you get annually 100 rupee, that's your coupon interest rate, and maturity you get a face value of 1000 rupee, that is maturity value, redemption value. This is a basic example. Same thing, I slightly change it. Your nominal value is 1000, but market value of the bond is 950. Assume that your nominal value is 1000, market value is 950. And then interest or the coupon will be how much? Same 10%, will not change. And your maturity value again 1000. So your nominal value is 1000, market value is 950, and interest annually pay 10% and 1000 rupee maturity value. Now please understand the difference between the initial example and now. The now, what has changed? Instead of investing 1000 rupee, you are going to invest 950 as an investor. So today you have to invest 950, not 1000 rupee. But annually you get interest, 10%, that is coupon rate, that will be same 100 rupees. And maturity value, again the 1000 rupee, you will get the 1000 rupees. So what's going to change? Instead of 1000, it's going to be 950. So investor is going to invest not 1000, 950. So he's going to you're going to invest lesser amount, but same 10% you get annually on the face value, not on the invested value. On the face value is now 1000. You get 100 rupee interest, and end of 5 years you get 1000. So this is your cash flow is going to be of the revised example. So what will happen? Your return or yield is your IRR of the instrument. You could calculate your IRR or return of the instrument. These are your cash flows. 950 you invest, 100 you get annual interest, 5 years, 1000 rupee the maturity value. What I would like to drive a point here, compared to earlier exam what we looked at, the difference is instead of 1000 I invest 950. So return or yield you will get, is it going to be 10% or more than 10% or less than 10%? So understanding you should have, even you can calculate IRR, even without calculating you should have an idea. Earlier I invested 1000 and got the same cash flows. 100 each year, 1000 at the end of 5 years, and I invested 1000. And my return or the yield was coupon rate, which is 10% exactly. Now I am saying I am investing 950, not 1000, but my all other cash flow remains the same. So I invest lesser amount and get the same cash flow like the early example. So my IRR, revised IRR or return or the yield will be how much? How much? More than 10%. I am not calculating the exact number now. I only want you to understand that you will get more than 10%. Why? Instead of 1000 you invested on 950, but all cash flow you are going to get same. So now 10% is your more than 10% is your return or the yield or IRR of these cash flows. So this is what you have to understand. When there is a change in your investment value, it can be redemption value. Sometimes the redemption value they can say 5% more than the nominal value. It's not 1000, 1100. Then you have to calculate your return or IRR and see what is your return of the instrument. So coupon rate and the return or the yield is two different things. Coupon rate and the yield is two different things. Yield is the actual return of the instrument. That is IRR you have to calculate based on these cash flows. Coupon rate is simply what is in the face of the document where they say 10%. That's what they pay you annually or half annually based on the nominal value. Based on nominal value they will pay this. So keep that in mind. How this yield and interest rate varies. Yield and coupon rate. Coupon rate is the rate on the face. So zero coupon bond means there is no coupon, but you will get the return at the maturity. So the 1000 rupee nominal value, the issue price, for example, say you will be issued at 850, and maturity value is say 1000. So what happens? This 150 actually forms your return of the instrument. It's not 1000 you have issued, you issued at 850, but Your maturity value includes your return of the instrument. So total return is calculated and added to your maturity value. So you can calculate, this is called zero coupon bond, you can read that out, right? Zero coupon bonds are issued to discount to the value. So that's 1,000 rupee nominally normally, you issue at 850. So 850 issue, at the 5th year the company will repay you 1,000 rupee so that your return is covered in that final payment. But you don't get annual cash flow, you don't get annual cash flow. Then we move on to the valuation of the bond. Valuation of bond. Now you can see that in the study pack, valuation of bonds. It's actually the corporate debt valuation what we looked at in the valuation chapter, right? It's about, you can see value of debt or the bond, debt or bond. You can see the interest into annuity factor, that means every year you get a coupon rate. So if you take every year or half yearly interest into the annuity factor plus your maturity value into your discounting factor. Maturity value and discounting factor, or maturity value or redemption value into discounting factor. So this gives you the value of bond. So what you have done here actually, interest, annual interest or semi-annual interest into the annuity factor plus maturity value in discounting factor. So valuation of bond, as you know, the conceptually it's about your present value of future cash flows. Keep that this in mind. Well, even on the valuation of shares we said it's always the cash flow based valuation. Cash flow based valuation, we say the value of the shares, value of the business equals to present value of future cash flow. In share issue or share valuation you have various techniques, but all cash flow based valuation, the ideology is valuation equals to present value of future cash flow. So value of bond equals to interest at annuity factor plus market value into discounting factor. Interest into annuity factor, market value into discounting factor. So that's basically your value of bond. So please be aware that this is what we have looked at in the valuation chapter also. You can look at it in the study pack, the example. Can you read that example? 2.21. SP company has an issue 12% bond with a par value under 1,000, that's nominal value, par value, nominal value. 12% debenture. Redemption value 110,000. Now see there is a value difference. 100 is the face value and 110 is the maturity value or redemption value. With interest payable quarterly. Now it's not interest paid annually, semi-annually, it's quarterly paid. Market yield on the bond is 8%. So they have given you the market yield mean that's the return for the similar bonds in the market. 8% annually and 2% quarterly. The bonds are redeemable on 30th June 2014 or whatever 2004 and it is now 31 December 2004. So we are talking about, I think ideally 4.5 years time period. So you can look at it, it's actually quarterly basis. Actually in not 4.5 years, 3.5 years. 2010 December, so that means 2020 or we'll just look at 2010. 2010 December you are issuing the bond, or now 2011 December, 2012 December, 2013 December, 2014 June. So 3.5 years is your total period of the bond. So we are now in 2010 December, 3.5 years period time the debenture is going for maturity. The question, calculate the market value of the bond. So what we have to understand, it has been issued at 100,000, redemption value 110,000, market value of the bond, market yield of the bond, they are given the market yield 8% annually, 2% quarterly. So what is the logic of calculating valuation? Value of bond equals to present value of future cash flow. You, before going into the number calculation, get the point clear, it's a present value of future cash flow. Any asset valuation, present value of future cash flow, any asset valuation. So whatever cash flow you can generate from the asset, discount that cash flows and calculate, that is the value of the bond. So here the required rate of return is your yield of the bond, So similar bonds in the market is trading at 8% annually or 2% quarterly. So if you are talking about quarterly return, if you look at it, 2% every quarter. If it is annual return, it's 8%. So calculating the present value, you can see that, as I mentioned, you get your interest or the coupon rate quarterly, not annually, quarterly. That into your annuity factor. So that is what they have given you in the study pack. You can see 100,000 is your debenture value or the face value, on which 12% is your coupon rate. Coupon rate is 12%. Quarterly you are paying, that means 3,000 you get interest. So quarterly as an investor you get 3,000 interest, which is the nominal value of your debenture into your coupon rate, which is 3% or 12% divided by 4, 3,000, and your annuity factor is going to be 12.10. That is because of your return requirement is 2% per quarter. On that basis, your present value is 36,380. Then the redemption value is 110,000. They have given you, it's at nominal, no, it's not at nominal value, it is 110,000. So 110,000, again discounting factor for 14 quarters, 83,380. So total present value, again please be aware, it's a present value of future cash flow. So after you investing in the bond or debenture, what are your future cash flow going to be? It's generally your interest cash flow, that's coupon rate you are going to get quarterly, half yearly, annually, all that cash flows, and the redemption value, the maturity value. Both cash flow you discount at the required rate of return or the bond yield in the market, So accordingly, your bond is valued at 119,698. Today your bond is worth 119,698. Now see, your bond face value was 100,000, but your market value at the moment 119,000. And the two things, one is your coupon rate is 12% and your yield of the instrument is only 8%. Yeah, yield is only 8%, but coupon rate is 12%, which means your instrument is offering you better return than the investor requirement, because your return of the instrument is, you are going to get 12% as the return, that is coupon rate, and the investor is requiring only 8%. So therefore your bond is more valuable than your face value. That is why you get 119,698 compared to your face value of 100,000. Then it's given in the Excel working how to calculate, so you could try that out. So they have given you the zero coupon bond. Generally the value of the bond is present value of redemption value, because there is no coupon rate. You don't have coupon rate interest in the zero coupon bond, only you have maturity value. So your maturity value, you discount factor, you multiply, that equals to value of bond. Zero coupon bond, you don't have two cash flows, only one cash flow, which is maturity value. But if it is normal government bonds or corporate bonds, you have the interest cash flows and the maturity value. Then the terminology or this valuation of bonds. So what you have to understand, that you simply calculate present value of future cash flows. So any bond, any type of cash flow they give you, any type of cash flow in the sense like the cash flows can be coupon rate and the redemption value. Redemption value is generally your face value, 1,000 rupees or 100,000, or it can be any amount, which can be a premium or with a discount at the maturity. Generally it's with a premium on what you call the same face value, not at a discount at the maturity. Generally you don't get a maturity discount. The logic is present value of future cash flow. Then we move on to the yield to maturity. So you could see that the study pack, actually yield to maturity is actually the return of your instrument, Return of the instrument from now onwards till the maturity. That's what it's called, yield to maturity. So if you take a debenture, if you are issuing fresh debenture today, whatever your return of the debenture you calculate based on IRR, that's your yield to maturity. But the same debenture after 2 years, 5-year debenture, after 2 years, you want to find out what is my yield of the instrument. You can again calculate your cash flows of the future and look at and see what is your return of the instrument. So you can see the return of instrument based on your future cash flows and today's market value, and see what is your yield of the instrument. So this is return of the instrument, and generally it's calculated by calculating the IRR. So can you look at this example? It's about 5-year unsecured bond. As I mentioned, the bond can be secured or unsecured. Here it's unsecured bond with a coupon of 5%. Coupon rate means based on your face value, the investor, the company who is issuing or the government will pay interest on the face value, that is 5% per annum. Redeemable at par. Redeemable at par means at the maturity you are going to redeem this bond at the par value, means face value. So there is no additional premium or discount. It's the face value of the bond. So 1000 rupees means 1000 rupee you are redeeming at, or 100 rupees means 100 rupees you are redeeming at. And issued at 6% discount to par will have a yield to maturity of 6.47. So the debenture is issued, or the bond is issued today at not 100 rupees, that's your nominal value, you are issuing at 6% discount. 6% discount. So 100 rupee nominal value debenture you are issuing at 6% less, that is 94 rupees. So you are issuing today to public or institution the debenture at 94 rupees. So assuming a nominal value of 100, they have given you the nominal value 100, calculating NPV at 5% and 7%. So they are helping out to calculate the yield of the instrument. You have to calculate the cash flows of this investment or the bond at 2 rates, because you have to calculate IRR, as I mentioned. IRR is the yield. So you calculate your IRR based on 2 rates. Firstly, you look at what are your cash flows. To calculate IRR, you need cash flows. Year 0, if you are the investor, year 0 you invest 94 rupees, not 100. Nominal value of face value is 100, but you invest 94 rupees. So 94 rupees I invest, 1 to 5 years, your cash flow you are going to get 5 rupees. 1 to 5 years, you are going to get cash flow 5 rupees. 5th year, you are going to have a redemption value of 100. 5th year, you are going to get a redemption value of 100. So you invest 94 rupees and you get annually 5 rupee interest, and you will be redeeming at 100 rupees. So these are your cash flows. So when you look at your answer here, before you calculating any number, first identify whether I have taken the right cash flows. It's not that you are investing 100, you are investing only 94, 6 rupees less than your nominal value. But annually you get interest, that is coupon rate on the nominal value. Please be careful, because most people understand that I invested 94, so I should get interest on 94. No, you get on your nominal value. That's why it's called coupon rate. It is fixed. It's basically on your nominal value 100, you get 5% annually for 5 years. At the end of 5 years, the redemption value of 100. That means the investor will get 100 rupees from the company or government at the maturity period 5 years. So you get 94 investment, 5 rupee annual interest for 5-year period. Every year you get 5 rupee because it's annual interest. Early example quarterly, but here annual interest. 5 rupee get income. 5th year you get 100 rupee maturity value. So your cash flows, you are told, now you have to calculate what is my return. So return is going to be IRR of this cash flow. So that's why they have given you the example here. They have taken 2 rates, 5% and 7%, and you know that probably how to calculate IRR. That IRR is 6.47. So this is the yield to maturity. So your return is 6.47. That is yield to maturity. So that's given in the Excel sheet also. Even the coupon rate is 5%, your yield to maturity is 6.47. Yield to maturity for irredeemable debt. If it is saying irredeemable debt, means there is no redemption period. You get annual cash flow of interest only. So if you look at example 3.14, yield to maturity can be calculated using the perpetuity formula, that is annual interest divided by current market value. Annual interest divided by current market value. So you can see annual interest is 4%, that is coupon rate 4%, divided by the market value, which is 93 rupees. 93 rupees. That gives you 4.3 is your what you call the yield to maturity or the IRR of the instrument. 4.3%, not the 4%. 4% is coupon rate. 4.3 is your yield to maturity. That is, you are talking about irredeemable debt. You divide your annual coupon rate by the market value. Market value. I am showing the cost of equity calculation and the valuation chapter. Cost of equity under not valuation, cost of capital chapter, we would have looked at how to calculate cost of equity of a what you call the company without having a specified period, right? You don't have a dividend growth, you have same dividends annually, how to calculate your yield or the cost of equity. That is D divided by market value, D divided by market value. Same thing here, yield to maturity for irredeemable debt is you take your coupon rate divided by your market value. So basically that gives you the yield to maturity. So we have an idea now the coupon rate, because generally you might have confusion, the coupon rate and the yield. Coupon rate and yield of the instrument, or the yield to maturity you can call it. These two are not same. This is not the same. Coupon rate is always calculated on nominal value. Nominal value. Yield is actually your IRR. IRR of your debenture or bond. So these two are different. But you may have debenture or bond where the coupon rate and the yield can be equal. That means your face value of the debenture or the bond and the maturity value are same, 1000. So there is no discount at the beginning or there is no premium at the end. So if there is a simple basic initial example what you looked at, 1000 or 100, you have 5% interest. That means your 5% is your actually the return. So the yield and coupon rate will be the same. Otherwise, if you take your bond is trading at the not at nominal value, if the market value is different to your nominal value, or your maturity value is different to your face value, then your return or the yield will be different to your coupon rate. But cash flow point of view, what you are going to be paid, what you are going to be paid annually is coupon rate, not the yield. You don't get yield paid by the company. Yield is a calculated number. IRR is always a calculated number. IRR is not something you can be paid by somebody. IRR is only calculated number and so this is a return you can get if you do this like this kind of thing. Coupon rate is the rate you are going to be paid on your nominal value by the corporate or by the government. So they will pay based on the coupon rate on the nominal value. Every year the cash flow or quarterly cash flow you will get. So please be aware the cash flow point of view, this is what you get. But return calculation point of view, this is the yield to maturity which is IRR what we have done. So be knowledgeable on this difference. Then the market value of the bond. Market value of the bond, there are certain determinants, right? There are certain things which will determine your market value bond. I think you can see here, page 69, determinants of value, right? Then you move on to the page 60, next page. The value of the bond will depend on the following factors. Carefully understand this, because more than the number calculation, you need to get the knowledge of theory properly, right? Because that will, any example, any question, you can put your theory properly and understand what you are talking. Otherwise, you are just memorizing a number calculation. You just want to discount, you multiply and say, I have done it. No. So let's get the principle right, so that any kind of instrument you can understand better than just doing numbers. They say the bond value will dependent on three things. Return required. Return required means the investor is requiring return for investment. He is requiring, not that he is going to get, he is requiring. So the return requirement will be the rate, you will take it to discount your cash flows. In order to calculate the value of your bond, you say present value of future cash flow. When I say future cash flow, I can put your future cash flow. To get the present value, I will discount. So I need a return. So what is the return I am going to use, or what is the discounting rate I am going to use? That is your return requirement of the investor. So that's what they say, higher the return requirement, lower the value of the bond. So when my return goes up, value of the bond comes down. Why? I am discounting the future cash flows by that requirement. So if I take an example, say my return requirement, say 10%, and calculated market value of the bond, say 115, right? If I say my return requirement is 15, what will happen to my market value? My return requirement has gone up. Cash flow will not change. My annual interest coupon rate will not change. Maturity value will not change. Only discounting rate has changed. 10% has become 15. I want more return, 15%. Same cash flow of the instrument. What will happen to market value? Market value will come down. It will be lower 150. I am not calculating the number. Lower than 150. Why? If the return requirement goes up, market value comes down. So it's always inverse relationship. Return requirement and market value of the bond have an inverse relationship. So when you say the market rates, interest rates or yields, market returns expectations are increasing, you will have to understand your value will come down. Any asset value will come down. If the market interest rates are going down, opposite. Market value of the bond assets goes up. So please be aware, this is again the valuation chapter of shares. We said that return requirement and market value of shares. Say same 10%, your share value is say 60 rupees. If I say my return requirement is 15%, what happens? This 10% has increased to 15. 10 has gone to 15. Then market value, what happens? Same dividend cash flows, my shares. Same dividend cash flow in my shares. 60 rupee, since my return requirement has gone up, I am going to discount the future cash flow at higher rate. That means your market value will be lower than 60. So what is the relationship? This is going up, this is coming down. That is again inverse relationship. So please understand, return requirement of the investor and the market value of the instrument, any instrument. Here we are talking about bonds, here I am giving you shares, right? I am just giving you a comparison. Both, since you have looked at earlier here, right? So you need to understand your return requirement and market value have inverse relationship. It's opposite. So that is one of the determinant, return requirement. Second, the coupon rate. Higher the coupon results in higher cash flows and therefore higher percent value. That's obvious, right? You have a higher coupon rate, that's your future cash flow. If the higher coupon rate means nominal value, you calculate earlier at 8%. If you say new bond you are issuing at 10%, the investor will get more cash flow. That means your present value will be more. So higher the coupon rate, generally market value will be higher. We are looking at one factor at a time. Third, principal or discount future cash flow have been, that's not the point. So there are 2 points. One is the return requirement, other one is the coupon cash flows. So the 4.1 example, can you look at the example? Page number 74, 4.1.1. A 5-year unsecured bond, with a coupon of 5% per annum. So it's unsecured bond, 5-year maturity period we have. Now when you read it, you get in your mind, right? 5-year bond, unsecured, 5% coupon rate, that is the nominal value you are going to pay 5% only. Redeemable at par, there is no extra premium paid. So we know that it's a 5-year bond, 5% coupon, redeemable at par. Given the issuer's credit rating, now I mentioned earlier rated, unrated, based on the credit rating, it can be AAA or BBB minus, whatever the credit rating you are, based on that yield of 6% would be expected. So this kind of company, this kind of instrument, in the market people or the investor require 6%. It's not coupon rate, requirement, that is the required rate of return, 6%. Now the bond is trading at 94 rupees, which is 6% discount on its par value of 100. So bond is trading at 94 rupees, but the investors are requiring a return of 6% and other information given. Question 1 or the A part, calculate the value of the bond based on the required yield of 6%. So read properly, they are asking you calculate a bond value bond. Now we know that there are two values here, one is the nominal value, that's just face value, and the trading value, that's the market price. Actually market price of the bond is 94, but they wanted you to calculate value of the bond based on the required yield of 6%. So in the market they say the yield is at 6%, so at 6% what is your value of the bond? So what is the basis we said? Value of the bond equals to present value of future cash flows. So you need to know the cash flows and discount using your return requirement. So future cash flows will be, it is about 100 rupee nominal value debenture or the bond, 5% coupon rate. So it's annually paid. So 5 years you are going to pay 5 rupees on your nominal value of 100 rupees. 100 rupee nominal value, 5% coupon rate, 5 rupee annually you get. So that's your cash flow. And at the maturity, they say that you will be redeeming at 100 rupees, redeeming at par. So you know that redeemable at par. So year 1 to 5, 5 rupee interest you get, nominal value at the maturity 100 rupees. So you are discounting your present value. In order to calculate present value, you need a discounting rate, that's the return requirement of the investor. They wanted you to calculate a 6% yield. 6% yield the investor wants it, required yield is 6%. On that basis, your value of the bond is 95.76. Simply it's the present value of future cash flow. Future cash flows, we know how to get the future cash flow. Year 1 to 5 I get annual interest 5 rupee and maturity value I get 100. And my coupon rate is 6%. Not coupon rate is 6%, my yield requirement is 6%. On that basis, my market value or the inherent value based on my cash flows for the investor who wants 6% return, the value is 95.76. This is the what you call the fair value of my bond based on the return requirement of the investor and based on the cash flow what the investor is going to get, the return, the cash value is 95.76. But market price of the same bond is how much? 94 rupees. Market, it's trading at 94, but its value 95.76. It's worth 95.76. So we read the second part of the question. What is the yield to maturity based on the current market price? Now there is a second part is, they are not touching about your comparison between trading price and this. They want you to calculate what is your yield of the instrument. We told you yield of the instrument is basically IRR of the instrument. So we need to get your IRR of the instrument based on the cash flow. So the investor is going to invest 94 rupees, that's the trading price, and he get annual 5 rupees, at the maturity 100 rupees. So that's in the next example. Answer, your yield is 6.47. Your yield of the instrument is 6.47. IRR of your cash flows, which is taken at 2 discounting rate, 6.47. So they say that your 94 rupee investment, annually I get 5 rupee interest, end of 5 years I get 100, my return going to be, yield going to be 6.47. Third part of the question, State whether the bond is undervalued or overvalued, and state whether the yield is on the bond is higher or lower than required by the investor. So there are two parts. The examiner has given a very simple question, but then he wanted you to get the idea proper. Firstly, you have to answer bond is undervalued or overvalued. We value the bond, and we value the bond based on return requirement of the investor. Bond is worth 95.76. Based on return requirement of the investor, it's worth 95.76. But trading price, market price 94. Undervalued, overvalued. So C part, the market price of the bond is 94, which is lower than the value calculated at 94. So the bond is trading at undervalued. Even though worth 95, but trading at 95. It can happen, right? You see that when the economic conditions are not good, you would see that certain area, certain assets may be not getting at a higher price, right? Depends on the demand, right? Depends on the demand. So when the country is in a recession mode, right, you may not see that some of the assets don't get right price, but it's worth it. It's worth it. I know that during before 2009, where the war was happening in Sri Lanka, most of the properties which are tourism sector properties, right? It could be hotel properties or any other tourism related properties were very undervalued. Why? Those are not generating sufficient cash flows or income, even though those are proper assets, but don't generate enough cash flows or income. Therefore, the valuation of the assets are very low, very low. But after 2009, it all got good values because then they started creating cash flow. So even now, if you take 2009 or 2020, last year, immediately after COVID, there are certain assets, certain hotel stock or the hotel assets, valuation came down. Not that the assets are not worth, but nobody want to buy that because you have to make money from that on the industry, hotel industry. So if you don't get enough tourism income, you may not be able to make money out of it because present value of future cash flow is a valuation. So future cash flow, if you are not very much sure at that point, the assets value are lower. Maybe now I think we have come a long way, like almost a year we are gone and now we are in a vaccinated move. So we believe that this problem could be slowly settled down and then we will be able to generate income, and those hotel industry income will start generated. Then the valuation is again picking up. Valuation is still picking up. So please understand, your value here is undervalued stock because 95 is the worth, but 94 only trading. Yield of the bond we calculate as 6.47, but the yield required by the investor is 6%. So yield of the bond, actual yield of the bond is more than the requirement of the investor. So that's the C part of the question. So we need to know that how to calculate the value of the bond, how to calculate the yield of the bond. When you calculate the value of the bond, you take present value of future cash flows. In that scenario, you don't take the investment cash flow. Always remember that you don't take the investment cash flow to calculate valuation of the asset. Even in the share valuation, value of the asset is always present value of future cash flow. Whatever cash flow you are going to generate from the asset, you discount and say this is the worth of the asset. You can compare that with your trading price. Then you see it's worth to buy or not worth buy. Yield of the instrument is IRR of the instrument. In order to calculate IRR, always you take the investment cash flow and the recovery cash flow. Both you compare and see what is the inbuilt return of that cash flow. Okay. There are other things you could read it out. Now you can see an example here. 4.23, 4.2.3 bond values and nominal values. 5-year unsecured bond with a coupon of 5%, redeemable at par has just been issued. So they have issued a bond, 5-year bond, unsecured, 5% coupon rate, redeemable at par. Calculate the value of the bond. If the required yield is 3%, 5%, 7%. So they have given you the requirement of the yield and you want to calculate the value. So as we know that in order to calculate the value of the bond, you need to present value of future cash flow. So future cash flow will be 5 rupees. If it is 100 rupees, you will be saying 5 rupees your interest annually, 5 years, and at the end of 5 years, you get the redemption. Redemption is 100 rupees. Discounting rate will be your return requirement, that is 357. 357. So we go to the answer. You see the 3 answers are given. At the return requirement of 3%, same bond is worth 109 rupees. If the return requirement is 5%, the same bond, same cash flow, same bond, 100 rupee worth. And 7% return requirement, the value of the bond is 91. So as we mentioned earlier, return requirement when you start increasing, value of the bond comes down. It's opposite direction. Return requirement of the investor and the value of the bond are two opposite side, right? So when your returns are going up, investor return requirements are going up, value of the bond comes down, value of the bond comes down. On that basis, you can see that 3% 109 rupee, 7% 91 rupees. So when the return requirement increases, market value of bond comes down, market value of bond comes down. But if your return requirement and the coupon rate is equal, return requirement and coupon rate is equal, that means return requirement is 5%, coupon rate is 5%. Then your market value will be equal to your face value. Market value will be equal to face value. That is 100 rupees. In this example, you can see they say 100 rupees 0.05 and they have accepted its exact percent value is 100, but actually decimals when you calculate, slight change can be there. Then there is a graph given, years to maturity and the bond value. So you can see that the bond value can be 109 rupee for 5 years, but when you come to closer, your bond value, trading bond value become 100. So at the maturity, actually at the maturity, it fits 100 rupee face value, redemption value, it will be 100. But 5 years time, when you look at it, it is 109 rupee, slowly goes down and comes to 100 rupees. Then there is another concept in the bond market or bond investments people use, it's called duration. Duration. It's a concept called duration. It's actually it's an average time period of your investment. Average time period of your investment. So how do you calculate that? You can read out that theory side of it. You can look at the example here. Bond X is a 6% bond maturing in 3 years time and has a gross redemption yield of 3.5%. Current price is 1070.12. So it's a 3-year bond. It's a 3-year bond and 6% is the coupon rate. So you can see that 1000 rupee nominal value, they have not mentioned, but it's understood that it could be 100 or 1000 only. Generally, even if they don't mention clearly, you can look at it. I think it's mentioned, it's mentioned 1000 rupee nominal value and par value only redeeming at par value. So year 1, 2, 3 you get 60 rupees interest or coupon interest. As an investor you receive every year 1, 2, 3 you get interest 60 rupees and my redemption value is 1000. Redemption value is 1000. So redemption value is end of 3 years. So 1000 plus the 60 your annual interest also you get. So 60, 60, 1060 are the cash flow you have. And the yield, they say the yield is 3.5. So you have been discounting that and calculating the value of the bond is 1070. Value of the bond is 1070. Then what you are calculating? You calculate the 1070 is your present value of future cash flow. Out of 1070, your cash flows. Year 1 you get 60 rupee cash flow, year 2 you have 60 rupee cash flow, year 3 1060 cash flow. But out of 1070 present value, you have 58% value for year 1, 56 for year 2, 956 for 3. So those are the present value components of respective years. So what you are doing is, you calculate your out of 1070, each year cash flows or present value, how much it represents. That is 5.42, 5.23, 89.35. Then you calculate for the weightage purposes, you multiply by the 1, 2, 3 years of the respective percentage and you add it together, it comes to 2.84 years. So you can look at the numbers again. 2.84 years is the your duration of your bond, right? That's basically how long it takes to convert your cash flow, how long it takes to convert your cash flows is basically the duration. So 2.84 is the time period. Even though it's a 3-year bond, based on your cash flows, your duration is 2.84. So that basically a financial market you use generally to understand the time period of the instrument. Generally, if you say a portfolio of investment, portfolio government investment, government securities you have or corporate bonds, you can calculate your average duration. That basically tells your portfolio what is the average time period to recover your investment, to recover your investment. So how long it takes. So we just say that, okay, my duration of my government portfolio is 3 years. That means you are on average you are talking about in 3 years you are maturing all your debentures. Why it's important? Say that it's expected that interest rates are going to double. Now the interest rates in Sri Lanka are very lowest rates. Say in 2 years time the interest rates what we have 4 to 5% become double, 9%, 10% levels. So double the rate. So if you say you have a portfolio at this moment, you have bought it recently, all your debentures or corporate bonds or government bonds you have invested, and your average duration is say 6 years. Then problem is all your government portfolio and the corporate bonds, your average duration will be say 3 years. Average duration is say 5 years. And your return what you are going to get from your bonds, what you have invested today, will be say 4 to 5% or 5 to 6%. But if it is 5 years time or it's maturing, in 2 years time your market rates go up, it becomes 10%. What happens? When the market rate goes up, you have to understand your rate is going to be 10%, but you are earning only 5 to 6%. So you will be loser. So when you are making a decision in portfolio investment, government securities or corporate bond investment, you have to consider the market interest rate environment properly. There is a percentage of things which nobody can predict. I know that everyone knows that. But there is a reasonable amount of percentage of prediction you can make based on how the interest is going to move. So based on that only you decide how much my duration going to be. So you don't foolishly go and put all your investments for long term at a very low rate. Now today's context the rates are very low. You go and invest that instruments or the government instruments or even corporate bonds you invest now at a lower rate. Unfortunately, when the interest rates start picking up in the market next 2 years time, your bonds which are 5-year bonds you will be having at a yield of 5-6%, whereas the market rates have gone up to 10%. So that is where you will start losing money. So please understand that when your portfolios are yielding very low return, when you have a larger duration, longer term duration, you are in trouble. If it is the other way, you are at a higher interest yield instruments with you, with a longer period, 2 years time your market rates are going to fall. In that case, you are laughing. Why? Your instruments are yielding at 10%, market rates are in 2 years time to 5%. So market rates are falling, but your instruments are very much higher. So you are in a better wicket. So you need to understand that depends on the rates in movement in the market, you will be penalized or sometimes you are going to gain. In order to decide that, you have to use this duration concept properly and evaluate. You can't be just put the money anywhere and just keep. No, the market always move up and down. Especially with the government changes, it happens. Right, earlier the government you would have had it at 10% levels, then it started slowly coming down because the government wants to push the economy faster so that more activities takes place, people will start borrowing money and investing, and a lot of activity means they don't just put the money in government security or corporate bond FDs and sit and wait. People start taking the money and putting into properties, businesses and the share market, other markets, all they will invest. So even you and me, when the loan rates are very lower, housing loans rates are lower, you or personal loan rates are lower, what do? You go and borrow money. You borrow money and invest somewhere. If you want to be on a safer investment, you can't again go back to government sector with lower rates, very low rates. So you go to the other investment opportunity. What are other investment opportunities? Share market could be one option, property could be another option. Businesses, you might start your own business, or your friends will start businesses, you will support them. So there are various ways that you will start investing. So government philosophy of bringing the rates down over the last 1.5 years is to ensure that more business activity take place, people borrow money and invest rather than keeping the money in the FDs and just sit and wait. You start earning from the other businesses. So other markets will start moving upwards, so the economy will have more business activities. That's the objective of always the interest rate reduction in any economy. So be aware of that. So as a portfolio manager or the investor, we all have to use duration as a concept to decide how to invest, or when to, where, how long we should invest. So I think there is a graph also given, yield and the price, yield and the price. You can see there is a yield and the price is mean yield and the market value. It has opposite direction, opposite direction. When the yield is more, the market value is lower. Right, you can see that there is a opposite direction. And they have given you the explanation there, you can read it out. There is another terminology or relevant to this bond related investments, which is credit risk. Credit risk. As I mentioned earlier, it's about a default risk. Default risk. That is, your lender or the company which issued the bond, whether they will default the interest or capital or both, right? That's basically the idea. The credit risk is whether the company which issued the bond or debenture will default its interest or capital or both. So if you say that I am very much sure that this company will not default, that means no risk, no credit risk or default risk. But if you say no, there is a percentage of risk I am thinking, then there is a risk involved. As I mentioned at the beginning, government bonds or treasury bills do not have that risk. Default risk is not there. We believe that government does not default. So credit risk or default risk is zero for government. So risk-free investment we call it because there is no risk of default. So they have given you some of the relevant thing. Credit risk measurement, right? The credit risk measurement, I look at it in the study pack, this table, that gives you the rating. As I mentioned earlier, the debentures, not the government bonds, I am talking about private sector or corporate bonds. When they are issuing the private sector bonds, the company could get the rating of the instrument. So rating, as I mentioned, Standard & Poor or Moody or somebody could do that rating for you and do that independent task and say that this is your rating, that is AAA, AA, A, BBB, BB, so that you have various rating ranking. So based on that, you basically describe your chances of default is how. So you can see that AAA company, highest quality, lowest default risk. Maybe a C, lowest grade quality. That means you are very much having a doubt that you will pay your capital or interest. So it's basically nobody would invest in that kind of instrument. But AAA one, no worries because it is the lowest default risk. Your chance of defaulting, say banks, leading banks in Sri Lanka, they are debenture, you are AAA rated. Don't worry about it because their chances of defaulting is very remote. That won't happen. Right? It's like government bonds, they also won't default it because they are so strong in terms of financial situation, they will not default. So that's basically the understanding you should get. The rating will tell you the credit risk levels. You can read that balance part. So what are the aspects they look at in giving the rating? As I mentioned earlier, your gearing of your company, cash flows of your company, your profitability, how you are strong in terms of your repayments, how your cash flows are going to work, how the financial flexibility you have, all the auditors' qualifications, all that relevant for rating company to decide the rating of your organization. Then there is something called credit spread. Credit spread. It's a terminology, credit spread. So what is credit spread? For example, say 5-year government bond. 5-year government bond, your yield, say 7%. 5-year government bond. As I mentioned, government bond is risk free. You may say corporate bonds, private sector. Corporate bond, private sector, it's actually with the credit risk, with credit risk. 5-year corporate bond. How much going to be the yield? Generally the investor will want 7 plus excess, some amount. 7% is you are getting in the government bond, no risk, you are getting 7%. So corporate bond with the credit risk. So obviously what? You want 7% plus something. This is called credit spread. In other words, the premium. In order to invest in this corporate bond, how much you want extra? That is credit spread, the premium. So that's basically explained here. Risk free rate plus credit spread equals to yield on corporate bond. Yield on corporate bond. That is a table and example. You can look at it. Yeah. So you will see that the credit spread generally will be based on the respective company's financial situation. Government bond, okay, we say the government bond 5-year, government bond 5-year, 7%. Say you have a AAA rated bank, a bank which is AAA rated. There you will say 7% plus say 2%. This is your spread. You want credit spread. You want you want the premium for your risk taking. And you say BBB company or another bank which is BBB. The 7% is the same government bond return. You want spread, but same 2% or more than 2%. Because your rating is AAA here, BBB here. Which company is more financially strong? The AAA company is more stronger than this company. So more strong company you want 2% spread. If you want 2% for even a more strong company, less strong company you want say for example 4%. So this is a spread you are wanting for this company. Why? Based on that company financial situation or rating, I want more spread than the good rated company. But both of these are requiring more returns than the government bonds. Why? Because same period, we are talking same period. Why they are giving low return? Because there is no spread you needed, because there is no risk. That means risk free investment. Risk free investment. So please be aware that government bond is risk free investment. Therefore your returns requirement is lower, and corporate bonds you would require more returns because you are taking credit risk. For the credit risk only we are talking about credit spread you want for respective investment. So what we have learned, main things under valuation of bond. One, how to calculate of your value of your bond. That is simply understand it's your present value of future cash flow. like share valuation and the free cash flow basis of share valuation, present value of future cash flow is the value of the bond. Second, we said yield to maturity. Yield to maturity, this is actually the return of your bond, return of your bond. So that's actually how do you calculate IRR. You calculate IRR. Third, we said the relationship between return requirement or yield, you can call it, and the market value. Right? Return requirement or return requirement or yield requirement and market value relationship. It is negative. It's negative. Then we said the concept called duration and the credit spread. Fifth one, which is actually we started with the what is the differentiation between government bond and corporate bond. Government bond and corporate bond, the characteristics. So please be carefully understand, or maybe the other one is the rating, how the rating is done by the companies and how the rating will determine your value of your instrument in terms of the yield. In terms of yield, the rating will disturb your yield because your corporate spread depends on your rating. So that also represent your credit risk. So this is a topic which is actually similar, some of the aspects are similar to what we have learned under valuation of shares. The valuation bond area is about the valuation shares area, right? All other aspects are especially for this. And what we need to understand that if I say you calculate the market value of the bond, say 150, and your trading price, you say your market value bond is 150, but you have invested say 120. So the difference between these 30 is called capital gain. So your bond has increased its value due to interest rate change in the market. So your market value of the bond has become 150, whereas you have invested 120 rupees. So you see that your value of the bond has gone up, so that 30 rupees is called capital gain. So always remember, when the interest rate move in the market, your value of the bond changes, value of the bond changes. So you would have bought say at 120 yesterday, today interest rates in the market changes and market value of the bond become 150. It may be very large amount I am talking, but just for understanding, the value has gone up. That's called capital gain. So it can happen the other way also. You bought it at 120, the market value bond in 1 week's time or 1 year's time, it has come down to 110. Then 10 rupees lost, that's capital loss. So this is in terms of the bond, you will see that apart from the interest or return what you talk about, the capital gain or capital loss also can take place based on your market value and your value of the bond what you are carrying. The difference between that is capital gain or capital loss.